The crowd says, diversify, follow trends, chase growth. Charlie Munger says, do the opposite, and that's how you win. Imagine it this way. Most investors are like villagers building houses on sand. They feel safe because everyone else is doing the same. But when the storm comes, those houses crumble overnight. Now picture something very different, a castle on a hill, surrounded by a wide, deep moat. It doesn't just survive storms, it thrives through them. Inside, wealth is safe, compounding year after year. That's the kind of business Munger wants you to own. In The Complete Investor, Munger explains that the secret isn't chasing what's popular. It's learning to identify moats, brands, loyal customers, scale, or technology that rivals can't touch, and waiting patiently for the right price. This is why he and Warren Buffett avoided the stampede of hot stocks. While others ran with the crowd, they studied like detectives, searching for companies built like fortresses. Then, when the time was right, they invested boldly, not in dozens of bets, but in a few that were undeniable. Most investors lose because they follow the noise. Munger wins because he ignores it. He knows that in markets, the herd is almost always wrong at the extremes, buying too high in euphoria, selling too low in fear. And here's the twist. Munger's entire approach begins with one deceptively simple question, the kind of question most investors never bother to ask. That's where Chapter 1 starts. And it might just change the way you think about investing forever. Imagine standing at the entrance of a vast, mysterious library, every book filled with secrets of money, success, and ruin, and you're handed a single Warren key that can unlock them all. That key is Graham's value investing system. And what makes it strange is how ordinary it looks at first glance, as if it were no more complicated than a pencil compared to a gleaming space pen. See, most people believe investing must be shrouded in formulas, equations, and dazzling tricks. Yet Graham built something so simple it almost feels insulting, like being told the magician's hat is empty from the start. Charlie admired that bluntness, because when you strip away glitter, the question isn't how clever you can look, but whether you can actually keep yourself from tripping over the same psychological traps that swallow nearly everyone else. Think of investing as a game with 3 baskets. Yes, no, and too hard. And the trick isn't in filling the first, but knowing when to toss things firmly into the last. Most investors fall because they can't admit ignorance. But Charlie compared it to a tightrope walker who survived 20 years. Only by knowing precisely what he doesn't know does he live another day. That's why the Graham system insists you work backward. Don't strain to be brilliant. Just remove obvious stupidity. The way a detective clears suspects one by one until the guilty truth is the only thing left. Here's where the paradox bites. In a roaring bull market, the system lags behind, looking almost pathetic. But when the music stops, its discipline shines like a safe locked tight against a storm. Imagine watching gamblers gather around a frog that promises riches if kissed, while the real investor simply tucks the frog away, knowing its talking mouth is more valuable than any fleeting magic trick. If you can't stomach falling behind the crowd today for the sake of outpacing them tomorrow, then Graham's way isn't yours, because it demands patience that feels like madness when everyone else is dancing. Charlie knew the market was a carnival of fools, and his edge wasn't secret genius but stubborn refusal to play their game, stepping aside until folly grew so loud the bargain screamed to be taken. The beauty is, unlike baseball, there are no called strikes in investing. So you can watch pitch after pitch pass by until one arrives so fat and obvious you feel insane not to swing. And yet, every swing comes with a reminder etched in cold math. After the croupiers take their cut in fees and costs, half the players must fall below average, and most don't even know it. Markets only work for Graham investors because they're imperfect, riddled with mistakes, irrational moves, and panic. And every crack in that surface is an open door for the one detective willing to stand still and watch. Charlie liked to remind people, if this were easy, everyone would be rich. But it's like poker, where the very belief that everyone can win is the biggest joke at the table. Opportunities never arrive on schedule. They come in lumps, ugly, sudden, terrifying, usually when others are running away. And the Graham investor waits, calmly loading up when fear blinds the crowd into selling gold for pennies. Still, most who try fail because they look in the mirror and see the chosen 10%, never the fumbling 90%, and that illusion drags them back to mediocrity disguised as hope. That's why for the majority, the honest advice is simple. Skip the chase, take a broad, low-cost index fund, and let the market carry you quietly without your emotions wrecking the ship. But if you insist on trying, remember Charlie's joke about the fishing lure salesman. Those garish hooks aren't built for fish. They're built for people who can't resist being dazzled, and Wall Street knows exactly how to reel them in. For the know-nothing investor, the index fund is mercy, but for the few who can sit still, stay rational, and treat each share like a true piece of a living business, Graham's system is a map to treasure. And so we arrive at the threshold. Will you be the gambler kissing frogs, or the detective who watches from the shadows, waiting patiently until the real prize finally reveals itself in plain sight? At the heart of it all lies a simple question. What is something truly worth? Around it, numbers drift like shadows, papers sprawl across a dimly lit study, and you sit there trying to make sense of it. 4. The room feels tense because every answer you've ever been given charts, forecasts, predictions, crumbles once you realize they're built on shaky ground, like castles of sand waiting for the tide. This is where Graham's principles enter, not as abstract theories, but as the detective's flashlight, cutting through fog and revealing the truth that's been hiding in plain sight all along. The first principle seems almost too obvious. A share of stock isn't a lottery ticket or a digital chip on a trading screen. It's ownership, a slice of a living, breathing business. Imagine buying a bakery on the corner. You wouldn't care about daily gossip on its price. You care about customers, bread quality, costs, and whether the ovens keep running day after day. That's how a Graham investor sees every stock, not as a fluttering graph line, but as flour, yeast, customers, rent, employees, and profits stitched together into a machine designed to survive storms. The detective's job is to dig bottom up, starting with what the business actually sells, who buys it, who competes, and how money really flows in and out, all before guessing any future dream. Charlie loved this approach because it avoids the trap of fortune-telling. Instead of gazing into crystal balls, you study the cash register, knowing today's ringing is more reliable than tomorrow's cloudy predictions. Every valuation begins here, not with fancy multipliers or borrowed models, but with the blunt question, if I own the whole thing outright, would I feel safe holding it for decades? If the answer is murky, walk away. Because owning even a sliver of something you don't understand is like buying half a horse without knowing whether it runs, bites, or even breathes. Now comes the second principle. Always demand a margin of safety. The buffer that keeps you alive when the world turns cruel, like leaving space on the road so you don't end up in a ditch. Paying less than something's worth isn't greed, it's protection. Because prices move, storms arrive, managers fail, economies stumble. And without that cushion, even the sharpest investor can find themselves staring into ruin. Think of it like buying a sturdy house below market price. If termites appear or storms batter the roof, you still come out whole because you built your future on a foundation of discount. Charlie knew most people ignore this. They see a price drop and panic, calling it risk. But Graham flipped the script. Lower prices mean lower risk. Higher prices mean danger dressed in shiny suits. That's why true investors cheer when hamburgers get cheaper, not when they rise. Because cheaper means you can buy more of what you love and still leave plenty in your pocket for tomorrow. The third principle is Graham's most colorful metaphor. Mr. Market, the moody partner who shows up at your door every day offering to buy or sell, swinging between despair and euphoria like a pendulum. One day he's depressed, shoving bargains into your hand for pennies. The next he's manic, paying absurd sums for scraps. And your task isn't to follow his moods but to exploit them. Charlie compared him to a neighbor constantly knocking, sometimes drunk with joy, sometimes sunk in sorrow. And the smartest move isn't to match his move, but to deal only when the terms scream opportunity. The trap is clear. Most people treat Mr. Market as gospel, chasing his highs, fearing his lows, and forgetting that his emotions are nothing more than noise, temporary, fickle, and self-destructive. By flipping the relationship, you make him your servant instead of your master, letting his manic swings serve your patience. And suddenly the market turns from a threat into a tool. Then comes the fourth principle, the hardest of them all. Be rational, objective, dispassionate. Even when the crowd loses its mind, even when your stomach twists, even when fear hisses at midnight, rationality isn't just a trick for profit, it's survival. Without it, you drown in the very ocean you're trying to cross, carried by waves of gossip and greed until your boat shatters. Charlie treated rationality almost like a moral duty, not because it made you richer, but because thinking clearly was the only way to stay human in a world built on self-deception. Every mistake investors make, overconfidence, panic, envy, traces back to abandoning reason, and the Graham system exists to anchor you, forcing discipline where chaos begs you to act. These four principles are deceptively plain, like four weathered tools hanging in a shed. But with them, you can build fortunes while others wreck themselves chasing storms and mirages. The first principle forces you to see businesses instead of tickers. The second demands you buy only when you have protection. The third teaches you to laugh at Mr. Market's mood swings. And the fourth insists you remain sane. Charlie often said these principles will never be obsolete. They are bedrock, unshaken by new theories, untouched by technology, immune to fashion, and every serious investor either follows them or falls. Yet knowing them isn't enough, just as knowing the rules of chess doesn't make you a grandmaster. You need temperament, patience, and that rare willingness to sit still while others burn with excitement. Consider this. Opportunities don't arrive like a steady paycheck. They come in bursts, sometimes years apart, and only the rational, the patient, the principled can recognize them without being blinded by noise. This is the detective's art, scanning rooms full of false leads, ignoring chatter, following evidence, and pouncing only when the proof is overwhelming, because one good case can outweigh 100 wasted hunches. And so these principles, stripped of magic, turn investing from a casino into a craft, where success depends less on brilliance than on the discipline to wait, watch, and strike only when it matters. The chapter closes not with a sense of completion, but with tension, because once you accept these principles, the question sharpens. How do you apply them when human psychology itself becomes the greatest enemy? And just like that, the study door creaks open into the next mystery, hinting at biases, illusions, and the strange ways our minds betray us even when we know better. Step into a deserted lighthouse at midnight, the beams sweeping across the waves, gears grinding in the dark, and it becomes clear you'll never chart the ocean by staring at one patch of water. That's the problem with most thinking. It's one-eyed, trapped inside a single discipline, where every puzzle looks like the same nail because the only tool in hand is a hammer shaped by training. Charlie called the cure worldly wisdom, and it's less about brilliance than about weaving together threads from everywhere: psychology, biology, mathematics, physics, philosophy, until you hold a net strong enough to catch reality as it truly is. Think of it like cooking. No one spice makes the dish, but blend salt, pepper, herbs, and heat. And suddenly the meal sings, while sticking to just sugar leaves you with sickness disguised as sweetness. Most people silo themselves, clinging to economics or law or medicine, as if their craft explains everything. But Charlie warned that this narrowness is a trap, like reading only the middle chapter of a mystery novel. If the facts don't connect across disciplines, they remain fragments, useless in practice, like puzzle pieces from different boxes that never lock together, leaving you with a jumbled mess instead of a picture. Worldly wisdom asks for a lattice, a structure of interconnected models. So when you encounter a new problem, you can hang it on the right branch instead of forcing it into the wrong slot. Picture a detective entering a crime scene with multiple toolkits: fingerprints, DNA, psychology of suspects, history of crimes in the area, Each model adds clarity, and the absence of one leaves the picture incomplete. Charlie loved this because he saw how often people torture facts to fit their pet models, bending reality until it groans, just so they don't have to admit their hammer can't fix every nail. Take economics alone. It tells you higher prices should reduce demand. Yet step into psychology, and suddenly you see luxury goods rise in demand as prices climb, because humans treat them like badges of worth. Ignore psychology, and you miss the truth. Ignore incentives, and you overlook the bribes behind decisions. Ignore history, and you repeat the same mistakes already paid for in blood, sweat, and bankruptcy. Charlie's lattice work lets you cross-check, like an auditor combing through accounts from different angles, making sure no single discipline blinds you, because blindness in money isn't academic, it's fatal. And here's the secret twist. Learning this way doesn't just protect you, it's fun, because every new insight triggers the brain's reward system, a chemical spark that makes curiosity addictive in the healthiest possible sense. Charlie compared this to gambling, where dopamine tempts losers to keep betting despite negative odds. But worldly wisdom flips that chemical lever so you get the same rush while stacking positive returns. That's why he never saw learning as a chore, but as fuel. And by making the process enjoyable, he built momentum others lacked, turning the grind of study into something closer to play. Still, there's nothing childish about it, because the lattice demands work, daily practice, constant integration, or else the models weaken, rust, and collapse when pressed by real-world uncertainty. Worldly wisdom insists you practice until it's reflex, like a firefighter running drills, because emergencies don't leave time for fresh study. They demand instant, disciplined application of tools you've already mastered. One model isn't enough, because reality is slippery, and a single map leaves you stranded when the terrain shifts. But with 10 maps layered, patterns emerge that no single guidebook could reveal. Charlie sometimes gave the example of mutual funds. Economics says raising costs should reduce sales, but psychology reveals higher commissions bribe brokers to push the product, while incentives explain betrayal of clients. Three disciplines converging to explain one ugly truth. Without multiple models, you call it a paradox, throw up your hands, and walk away confused. With worldly wisdom, you see the scheme for what it is, a manipulation hiding in plain sight. And it's not just business. Medicine without statistics becomes quackery, engineering without ethics builds disasters, and investing without history becomes a roulette wheel, all proving that cross-disciplinary blindness invites calamity. Charlie embraced being a fox, knowing a little about a lot. Because life rarely presents pure puzzles from one discipline, it throws messy mixtures where biology bleeds into psychology and economics into politics. Worldly wisdom doesn't chase precision at the cost of truth. It prefers being roughly right across many fields to being precisely wrong within one, like a tailor who cuts broadly but fits comfortably. That's why Charlie valued liberal education, broad reading, hours spent with books from every shelf. Because he knew reality laughs at narrow expertise, demanding breadth if you want resilience instead of brittle cleverness. He often said people calculate too much and think too little because they worship numbers while ignoring what numbers can't capture, overweighing what's measurable and neglecting the unquantifiable forces that often matter most. Investors obsessed with ratios, but blind to psychology miss how panic drives crashes. Analysts trained in models, but ignorant of history failed to see how bubbles rhyme with past follies. Lawyers blind to incentives miss corruption hiding in contracts. Charlie avoided that by constantly asking, what am I missing? What lens haven't I used? What model could expose the blind spot? That habit saved him from disasters that swallowed sharper but narrower minds. He urged everyone to read widely, biographies, science, philosophy, because every book adds another model to the lattice, another node to the net, another tool to the detective's kit. Worldly wisdom isn't a magic trick. It's a slow accumulation of filters, questions, and perspectives that, when layered, make you far less stupid than the average participant in markets or life. Because in Charlie's world, Success isn't about dazzling genius, but about consistently avoiding stupidity. And worldly wisdom is the most reliable shield against the blunders that ruin otherwise intelligent people. He practiced inversion, asking not just how do I succeed, but how do I fail and how do I avoid it? A model borrowed from mathematics, but applied everywhere from marriage to markets. Each mistake dodged was a victory. Each bias caught a treasure. Each cross-check another nail pulled from the coffin of foolishness. And slowly, like a craftsman, he built wisdom by subtraction. And here's the haunting part. Worldly wisdom isn't optional. Without it, you're prey, stumbling into traps set by those who know more models, armed with wider lenses, ready to exploit your narrow view. But with it, you tilt the field, stacking odds quietly in your favor, not by brilliance, but by refusing to fight blind, seeing patterns others miss, and acting when clarity finally emerges. Charlie knew the payoff wasn't just money, but a better life, more constructive, more helpful, more fun, and yes, enormously rich, because wisdom compounds like interest when practiced daily, relentlessly across disciplines. So the principle is simple, though never easy. Gather models, link them, test them, practice them, and when the storm comes, you'll be the one holding a sturdy net while others drown chasing single threads. And as this chapter closes, the mystery deepens. If worldly wisdom is the framework, what happens when the human mind itself betrays us, pulling us into biases, illusions, and traps we can't even see? The next door opens into psychology, the raw, unsettling map of human misjudgment, where the greatest enemy isn't the market or competition, but the tricks our own brains quietly play against us. Step into a courtroom where the jury is your own brain, and the trial is constant. Every decision, every judgment, every instinct put to the test under dim light and faulty evidence. The frightening part? The judge, the jury, and the witnesses all suffer from the same flaws, because the human mind, though remarkable, is riddled with biases that twist truth into shapes it never deserved. Charlie loved dissecting these tendencies because they weren't minor quirks. They were hidden explosives, capable of blowing apart fortunes, marriages, reputations, all without the victim realizing they had lit the fuse themselves. Think about heuristics, those shortcuts the brain uses to survive daily chaos. Without them, you couldn't choose cereal, cross a street, or decide what shirt to wear, because pure logic will grind you to paralysis. But here's the trap. What works in the jungle often backfires in markets. Instincts designed to save us from predators now shove us into foolish trades, like mistaking shadows for monsters and sprinting straight into a ditch. A famous economist once warned how people drag rules from one setting into another, like carrying an umbrella into the desert, mistaking tools for universal truths when they were born for narrower tasks. Bias, Charlie argued, was the real villain of human judgment, a distortion of probabilities, where crude mental math mixes with raw emotion, and the result is certainty about things that don't deserve certainty at all. Why does this happen? Because the mind evolved for survival, not accuracy. Our ancestors didn't need truth in decimal places. They needed speed, gut instincts, and quick rules to escape danger, not perfect models of reality. So here we are, modern investors with Stone Age brains, trying to navigate markets that reward patience and calculation, while our neurons push us toward immediate action, comfort, and the familiar glow of a confident story. This mismatch is deadly. It explains why bubbles form, why scams succeed, why people chase hype until collapse, and why even smart individuals sink into traps they swear they'll never touch. Charlie cataloged these tendencies like a detective pinning clues on a board, not to shame humanity, but to prepare for battle, because the fight isn't with markets, it's with ourselves. Consider reward and punishment, the most basic drivers of behavior. Like lab rats pressing levers, humans overreact to incentives, blind to the long term, seduced by immediate gains, and too quick to ignore hidden costs. Salesmen exploit this daily, offering trinkets, discounts, or urgent pitches. And even when logic screams caution, The thrill of reward floods the brain, bending reason until bad deals feel irresistible. Punishment works the same way, steering us away from unpleasant truths. Investors cling to comforting projections, denying cracks in their portfolio, because the pain of admitting error feels sharper than the risk of doubling down. This is denial at its rawest, a refusal to see facts that threaten the ego. It's the mother refusing to believe her son guilty, or the investor convinced a Ponzi scheme is safe. Charlie warned that denial kills faster than ignorance because it cloaks itself as optimism, and optimism, unchecked, can drag the sharpest mind into disasters that hindsight makes look almost childish. Then there's liking and loving powerful forces that blind judgment. Once attached to a company, a leader, or an idea, we defend it irrationally, ignoring evidence of weakness because love whispers louder than reason. Think of employees hoarding company stock even as cracks show, or investors clinging to charismatic CEOs whose charm hides incompetence. Love makes fools out of rational adults, turning portfolios into shrines for doomed idols. Flip the coin, and you meet disliking and hating. Bias works both ways. Disdain for a rival firm or distrust of a disliked leader can blind us to bargains, turning opportunity into waste out of sheer spite. Charlie knew life was too short to partner with those you despise, but he also warned against letting hate bleed into analysis, because hate, like love, distorts reality until decisions collapse under irrational weight. Another misjudgment hides in doubt avoidance. The human brain hates uncertainty, so it leaps toward answers, any answers, just to silence the discomfort, even when patience would yield better clarity. That's why prey animals bolt at shadows. Hesitation meant death in the savannah. But in investing, impatience leads to overtrading, chasing illusions, and locking into bad deals just to avoid lingering doubt. Social proof builds on this. People crave belonging, so they mirror the crowd, assuming if everyone's buying, the wisdom must be shared. But crowds often rush off cliffs, and markets prove it time after time. Charlie compared it to lemmings or panicked mobs, reminding that following the herd feels safe until the ground crumbles, leaving you trampled by the very safety you sought. Authority bias deepens the trap. Humans defer to leaders, experts, or even actors in lab coats, mistaking appearance for credibility and swallowing nonsense because confidence radiates from the wrong mouth. That's why celebrity endorsements sway purchases, why smooth-talking brokers lure investors, and why deference to supposed experts has led entire industries into ruin when no one dare question authority. Reciprocation works subtly. Someone gives you a small gift, a coffee, a smile, a compliment, and suddenly you feel compelled to return the favor, even if it means making decisions against your own interests. Marketers, salespeople, politicians all exploit this, layering obligation until you act not from choice, but from a script written by someone else's kindness. Consistency bias ties the knot tighter. Once you declare a position, pride demands you stick to it. Changing course feels weak, so you dig deeper, defending mistakes instead of admitting them and starting fresh. Charlie saw this in boardrooms, where leaders doubled down on failed projects simply because they had publicly supported them, preferring humiliation tomorrow to embarrassment today. Then comes envy, a corrosive emotion that poisons markets. People don't just want success. They want more than their neighbor. And in chasing outperformance, they take risks they'd never consider in solitude. Envy builds bubbles, fuels reckless bets, and explains why otherwise content investors suddenly gamble when they see others racing ahead, forgetting that long-term gains aren't measured in immediate comparison. Over-optimism joins the list, seducing investors into thinking skill explains luck, and luck will last forever. It drives projections beyond reason, fuels speculation, and blinds people to downside until collapse rips away the mask. And woven through it all is self-regard, that smug belief that we're above average, immune to mistakes, smarter than the room, when in reality, statistics prove half the crowd must fall below the line. Charlie joked that if you're not questioning whether you're average, you've already failed the test, because humility isn't weakness here, It's armor against the overconfidence that ruins portfolios. The grim truth: these misjudgments never disappear. They're wired deep, products of evolution, reinforced by society, and waiting to ambush every decision. The best you can do is recognize them, prepare for them, and counteract them. Charlie believed survival depended on this awareness. By cataloging the traps, he gave investors a map of minefields, not to eliminate danger, but to walk carefully where others blunder blindly. And so, this chapter doesn't close with comfort, but with warning. Your greatest enemy isn't Wall Street, competitors, or even random chance. It's the flaws etched into your own mind. The next door opens to a harder challenge. If human misjudgment is so pervasive, what qualities must an investor cultivate to rise above it and stand strong against the storm? Picture a quiet study late at night, the lamp cast in a circle of light, and you're staring at a single question. What kind of person truly survives the storm of investing? Not the flashes, not the loudest. The survivors are marked by subtler traits, almost invisible to the impatient crowd, but sharp as steel for those willing to look closer at the evidence. In Buffett's biography, one line stands out like a fingerprint. His genius wasn't tricks or secrets, but character, patience, discipline, and that rare independence of mind that makes noise fade into silence. Charlie shared this DNA. Both men built fortunes not on frantic action, but on temperament, the steady keel in wild seas, the refusal to panic or chase, the calm anchor in a storm. But here's the twist. You don't need to be Buffett or Munger. You don't need their exact mix of gifts. What you need is to cultivate your own version of the right stuff. Charlie never pretended perfection. He admitted his flaws, his struggles, his lapses. That honesty mattered because it meant these traits aren't divine lightning bolts. They're muscles anyone can train, though few have the grit. The first attribute is patience. Markets tempt you to swing at every pitch, to act as if constant motion equals progress. But patience says no. Wait, watch, and move only when the odds tilt heavily. Think of a hunter in the woods. Fire too soon, and you waste your shot. Wait for the right angle, and the opportunity becomes clean, certain, almost inevitable. That's how great investors think. Charlie once said success means being patient, yet aggressive when it's time. It's like holding a coiled spring, calm for years, then unleashing force when the rare perfect opening appears. Few stomachs can hold that tension. The danger lies in boredom. People equate activity with value, thinking sitting still means failure. Don't just sit there. Do something. Feels like wisdom, but for investors, it's poison dressed as advice. Berkshire thrived on the opposite. Sometimes they went years without a major deal, sitting on cash while the world scoffed, only to strike with overwhelming force when panic or neglect deliver golden bargains. Patience, though, is nothing without discipline. Discipline is the guardrail that keeps patience from dissolving into laziness or fear. It's the framework that stops you from grabbing scraps just to feel productive. Buffett compared markets to a baseball game with no umpire calling strikes. You could watch pitches for hours, days, years, until the right one comes along. Discipline means waiting without guilt or compulsion. But patience and discipline aren't glamorous. They look like doing nothing. They feel like idleness in a world that worships busyness. That's why most people fail. They can't stomach the optics of quiet. The second attribute is rationality. Emotion clouds judgment, whispers panic when prices fall, tempts greed when bubbles swell. Rationality is stepping back, asking, what is real here? What do the numbers and facts truly show? It sounds simple, but in practice, it's war. Fear and greed are primal forces, older than reason, and resisting them requires training the mind to pause, breathe, and test assumptions before reacting. Charlie treated rationality like a moral obligation. Without it, you become the market's prey, dragged by hysteria. With it, you cut through illusions, seeing value where others see disaster, caution where others see endless gain. The third attribute is independence of mind. Most people crave belonging, so they follow crowds, analysts, headlines. But true investors think alone, even when the mob mocks, because markets reward clarity, not conformity. Charlie called this contrarian courage. It's not rebelling for the sake of rebellion, but refusing to outsource judgment. It's saying, I see differently, and I'll act differently, even if the world calls me a fool. Independence can feel like exile. Imagine holding cash in the late 1990s while everyone else gorged on dot-com dreams. You look stupid until the collapse, and then you look like a genius. The fourth attribute is humility. Arrogance blinds. It convinces you that luck is skill, that success is permanent, that rules bend for your brilliance. Humility protects you by reminding anyone, anytime can be wrong. Charlie admitted his mistakes openly, analyzing them so they wouldn't repeat. This honesty built resilience, turning failure into tuition instead of tragedy, while others buried errors until they grew into financial tombstones. The fifth is adaptability. Conditions change. What worked in one decade may fail in the next. Adaptability means carrying timeless principles, but adjusting tactics, like a sailor trimming sails while the compass still points north. Charlie warned against rigid doctrines. The Graham system worked, but he and Buffett expanded it, shifting from cigar butts, cheap scraps, to quality businesses at fair prices, a pivot that multiplied returns. The sixth is focus. Distraction bleeds capital. Investors who scatter their attention across dozens of bets dilute insight. Focus means concentrating energy on a few high-probability opportunities, then watching them like hawks. Berkshire embodied this. They didn't need 100 deals. A handful of giants, well-chosen, compounded wealth far more reliably than constant tinkering. Focus is the magnifying glass that turns sunlight into fire. The seventh attribute is resilience. Investing demands endurance through storms, collapses, ridicule. Without resilience, even patience and rationality crumble. You need the grit to survive years of underperformance, knowing the tide will eventually shift. Think of Wells Fargo in 2009, when Charlie and Buffett doubled down as the world panicked. Resilience meant buying while others fled, holding steady while headlines screamed apocalypse, and emerging stronger when fear finally burned out. The eighth is curiosity. Charlie devoured books, ideas, disciplines. He called himself a learning machine, and this endless hunger meant he arrived at problems armed with more models, more lenses, more tools than the average investor. Curiosity fuels adaptability. Without it, you calcify, repeating outdated strategies until markets crush you. With it, you evolve, finding new edges, sharpening old skills, and staying alive when others go stale. The ninth is temperament. Jason Zweig once described it with a Greek word, ataraxia, imperturbability. It's the calm of Socrates at trial, the poise of Buffett investing billions in chaos, the serenity of Charlie ignoring noise. Temperament is the invisible shield. It doesn't eliminate fear, but it keeps fear from dictating action. It's knowing markets will swing, bubbles will burst, but your framework stands, unshaken, unmoved by hysteria. Finally, there's integrity. Without trust, wealth rots. Charlie and Buffett built reputations that made deals easier, partners loyal, and mistakes forgivable. Integrity compounds like capital, opening doors money alone can't buy. A crook genius may win for a season, but sooner or later, reputation catches up. Integrity ensures survival, because trust once broken is almost impossible to repair, and investing is a marathon of decades. These attributes, woven together, form the right stuff. Not talent in isolation, not brilliance alone, but character, the quiet virtues that compound silently unseen, until one day the world calls them genius. And here lies the suspense. If these qualities matter more than IQ or insider tricks, the real puzzle becomes, can ordinary people, flawed and human, truly build them into habits that hold under pressure? That question lingers like an open file on a desk, leading us straight into the next chapter, where Graham's system stretches into 7 variables, showing how even within the same principles, styles diverge. Walk into a dimly lit laboratory where every bench holds a strange instrument, each built to measure something invisible yet vital, and your task is to decide which tools matter most for survival. The Graham system sets the foundation, principles carved in stone, but the variables are where individuality creeps in, shaping styles, strategies, and personalities like different fingerprints pressed upon the same universal blueprint. Charlie called these variables the levers of variation, the places where even committed Graham disciples diverge, still loyal to the creed, yet distinct in practice, like jazz musicians improvising around the same steady rhythm. The first variable concerns intrinsic value, the holy grail of investing, that elusive estimate of what a business is truly worth, not in the market's eyes, but in the long, cold arithmetic of cash. Buffett once defined it as the present value of cash that can be taken out of a business during its life, a number always fuzzy, always shifting, like a shoreline under waves of changing tides. You can't fix intrinsic value with a compass or a formula alone, because businesses breathe, evolve, stumble, thrive, and every forecast is part science, part imagination, part humility before the unknowable. Some companies are easy. A toll bridge, a utility, a cash cow with predictable flows. Others are opaque, slippery, impossible to model with confidence. And here investors split. Some dive in, others walk away. Charlie preferred caution. He admitted he didn't try to value everything. Why wrestle shadows when sunlight shines elsewhere? Better to work within clear sightlines than gamble in fog thick enough to hide cliffs. The second variable is margin of safety. Graham hammered it like a mantra, the buffer between price and value, the cushion protecting investors from both miscalculation and the market's cruel surprises. One investor's margin may be wide, another's narrower. Some demand bargains so obvious they seem comical. Others accept thinner cushions if the business quality is extraordinary. Style emerges in how thick you want the padding. Charlie insisted the margin was non-negotiable. You wouldn't drive without brakes or skydive without a chute. So why would anyone buy without protection? Yet countless investors ignore it, hypnotized by the mirage of certainty. The third variable is circle of competence. Imagine a map with a glowing border, inside clarity and skill, outside darkness and traps. Each investor must know their border and respect it ruthlessly. Buffett once joked that knowing your boundaries matters more than their size. Some excel with vast circles, others thrive in narrow niches. Trouble comes when arrogance pushes you into fields where you're blind. Charlie urged brutal honesty. If you're 5 feet tall, you won't be an NBA star. If you don't understand biotech, don't pretend. Stick where your brain has earned genuine insight. The fourth variable is portfolio concentration. Do you scatter across dozens of bets, spreading risk, or pile into a handful magnifying conviction? Graham students land all over this spectrum, each convinced their balance is right. Charlie and Warren concentrated. They believed wide diversification was an excuse for ignorance, a crutch for those unwilling to study deeply. For them, a few great ideas, held tightly, outperformed the zoo of mediocrity. Others disagreed, preferring safety in numbers, even if it diluted returns. Both are valid paths within the Graham tradition, but the variable reveals temperament, comfort with bold exposure versus desire for broad protection. The fifth variable is cash reserves. Some investors stay fully invested, riding every cycle with no dry powder. Others hoard cash, waiting for storms, eager to strike when panic discounts treasures into the gutter. Charlie and Warren leaned toward patience. Cash was a weapon, not dead weight. It meant readiness when opportunity knocked, a war chest when others were crippled, liquidity as advantage rather than drag. The sixth variable is time horizon. Graham investors agree on long-term focus. But how long is long? Some think in years, others in decades, and Charlie often stretched to half-centuries, seeing businesses as lifetime companions. Time-shaped strategy. A trader seeks quick wins. A Graham investor waits for compounding to perform miracles. Yet even within the camp, horizons vary, reflecting personality, obligations, and trust and patience as capital. The seventh variable is attitude toward Mr. Market. Graham's manic-depressive metaphor remains, but interpretations differ. Some investors glance at him daily, others rarely. Some treat him as signal, others as noise to be ignored. Charlie smiled at this metaphor because it captured so much in one image. Mr. Market wasn't your guide. He was your servant. But how strictly you enforce that boundary defined your investing identity. Together, these 7 variables form a prism, refracting the same light into distinct colors. The Graham system binds them, but style emerges in how each investor bends the rays to fit temperament and conviction. Charlie admired the diversity. He never claimed one exact formula fit all, only that deviation from the principles spelled doom. Within the frame, individuality thrived, but outside it, folly multiplied like weeds in an untended field. And so the mystery deepens. If the principles are constant, but the variables flexible, the detective's question sharpens. What mix of choices best suits not the market, but you, the flawed and human investor? That's where the journey turns next, to businesses themselves, and the qualities within them that reveal whether the right stuff lives not just in the investor, but in the enterprise itself. Hidden among the stalls are businesses with souls, strengths, and secrets worth uncovering. Around them rises the clamor of coins, the scent of fresh bread, merchants calling out as dawn breaks, and the marketplace comes alive. And there you walk, taking it all in. To Graham and Munger, a stock is never just paper, never just numbers scrolling on a ticker, but a living slice of a real business, beating with management, assets, and competitive terrain that must be understood. Charlie believed you cannot be a serious investor unless you grasp the fundamentals of business itself, because value isn't created in abstractions, it's born in daily operations, decisions, and durability. So, what makes the right business? The first clue lies in management, the stewards holding the keys to capital, culture, and future. At Berkshire, management was radically decentralized, yet capital allocation remained tightly centralized at the top. This duality mattered. Subsidiary managers ran their businesses with autonomy, shaping operations with freedom, while Buffett and Munger reserved control for the one decision that mattered most: where the money flowed, where resources would be planted next. Capital allocation was, to Charlie, the supreme test. He said plainly, an investor's number one job is allocating capital properly, because every misstep compounds losses, while every sound move compounds gains across decades. Consider it like gardening. A mediocre gardener can water evenly but starve the rare roses, while weeds flourish. A great gardener pours resources into the most promising plants, pruning the rest, ensuring the garden thrives. But management alone wasn't enough. Berkshire showed another clue, a seamless web of trust. Buffett kept headquarters lean, fewer than 30 people, while vast empires of subsidiaries thrived independently, guided by culture rather than micromanagement. Trust meant fewer layers, fewer costs, and faster decisions, but it demanded integrity at the top. Without honesty, the centralization collapses into chaos. With honesty, it becomes an almost magical system of alignment. Still, the true heart of a business lies in its moat, that mysterious, durable edge keeping competitors at bay, like walls protecting a castle against endless waves of invaders hungry for plunder. Charlie defined moats in simple terms, some inherent trait that defends profits against erosion. It could be brand, scale, patents, network effects, or switching costs, but the key was endurance, not temporary advantage. He warned that businesses without moats eventually regress to the mean, like rivers flowing downhill. Competition eats margins, and what once looked like a fortress becomes a ruin, weeds overtaking cracked stone. Investing, then, became detective work, studying not just numbers, but whether the moat was wide, durable, and capable of holding against time's relentless siege. Without this, no price was truly cheap enough. Charlie explained moats 2 ways: characteristics that create the advantage and resilience that sustains it. A moat must defend itself, renewing strength as attacks mount, not collapsing at the first breach. Think of Coca-Cola. Its brand wasn't just recognition, but habit, loyalty, and taste memory imprinted in billions of consumers. That moat repelled decades of challengers who tried, failed, and faded into trivia. Or American Express, where the moat came from reputation, networks, and embedded trust in payments. Competitors could mimic technology, but struggled to replicate the brand's aura, credibility, and scale of use. Without a moat, Charlie said, all you own is a temporary lease on profits, doomed to shrink. With a moat, you own compounding protection, a fortress that grows stronger as decades roll. Yet even moats weren't enough. Quality mattered. Charlie insisted that great money came not from cigar butt scraps, but from high-quality businesses that reinvested capital at extraordinary rates, creating self-reinforcing cycles of growth. The best business, Warren once wrote, is one that can absorb incremental capital at high returns for long stretches. The worst is one that eats capital endlessly while delivering meager or declining returns. This is why Buffett and Munger gradually shifted from Graham's cigar butt bargains to businesses like See's Candies, quality firms with pricing power, customer loyalty, and compounding returns that multiplied wealth reliably. The secret wasn't just buying cheap, but buying excellent at fair prices. Charlie explained, quality is like a tailwind, pushing results forward year after year, while low-quality businesses are headwinds that erode returns. But how do you spot excellence? One clue is in return on invested capital. Numbers don't lie for long. A business consistently earning high returns on capital signals a franchise, while erratic returns hint at fragility. Growth alone doesn't impress. Buffett warned, growth only creates value when each dollar reinvested generates more than a dollar in market value. Otherwise, growth is just motion, expansion without enrichment. Charlie also pointed to culture. Berkshire's culture prized autonomy, trust, and rationality, and those traits created compounding advantages. Businesses with corrosive cultures, greed, bureaucracy, dishonesty, eventually poison even strong moats. The right business, then, is a blend: wise management, rational capital allocation, durable moat, and culture aligned with long-term compounding. Miss any piece and cracks appear, widening until collapse. But Charlie's eye for moats extended deeper. He compared them to ecosystems. Some businesses thrive in niches, safe from predators, but niches can vanish, while true moats endure across landscapes, protecting even in shifting climates. He admired managers like those at Isker, where skill and intensity combine with durable advantages. Talent mattered when paired with the right structure, but he warned against relying solely on genius to rescue poor fundamentals. Buffett echoed this. Invest in a business even a fool can run, because someday a fool will. Moats and structure matter more than genius leadership, because genius is rare, mortality is not. The challenge for every investor is balance. Too much faith in management blinds you. Too much faith in numbers blinds you too. Wisdom is seeing the whole: moat, capital, culture, people, and prospects. Berkshire itself embodied these lessons. It became the buyer of first resort for family businesses because sellers trusted Buffett and Munger to preserve culture, protect employees, and avoid debt-driven gains of private equity. That trust became a moat in acquisition itself, letting Berkshire acquire gems at favorable prices because owners wanted continuity, not just the highest bidder. Reputation became competitive advantage, compounding goodwill into deal flow. Charlie understood this deeply. Reputation is a moat you cannot buy, only earn. It compounds slower than money but lasts longer, and once broken, it rarely repairs. So the detective work circles back to the same haunting question. If businesses are living organisms, how do you know which ones will endure, which moats will hold, which cultures will outlast generations? There is no formula, only judgment honed by study, pattern recognition, and humility. The right business reveals itself slowly, like a mystery novel where each chapter tightens the web of clues until the truth shines. And so the stage is set. If the right business has the right stuff, the next puzzle is calculation itself, putting numbers to the mystery, estimating intrinsic value with precision sharpened by principle. You're in a hush study, chalkboard crowded with symbols, sunlight cutting across a desk piled with papers. And waiting at the center is the riddle of riddles. How do you figure out what a business is really worth? Plenty of investors act as if the answer is obvious, carved in stone like a mountain's peak. But Charlie and Warren laid it bare. Intrinsic value is never sharp, always a little blurred, yet you can't ignore it. Because it's the only compass that still works when the sky's cloudy and the stars are half hidden. At Berkshire, the process looked deceptively simple. They used owner's earnings, a figure stripped of accounting noise, focused on actual cash left after essential expenses, the lifeblood that could be withdrawn without starving the business. Owner's earnings began with net income, then added back depreciation, depletion, and amortization, while subtracting necessary capital expenditures and additional working capital. In essence, it measured not illusions of profit, but money truly available. Charlie disliked gains with EBITDA or adjusted numbers. He considered them fairy tales whispered by promoters. If cash wasn't flowing, reality wasn't there, no matter how elegantly spreadsheets suggested otherwise. Once owner's earnings were estimated, Berkshire projected a conservative growth rate. Never rosy, never heroic, because optimism kills investors faster than pessimism. The numbers were then discounted back using the 30-year U.S. Treasury rate. This step baffled many. Why such a low risk-free rate? Buffett explained, every decision is a comparison, and the risk-free bond is the universal yardstick. If nothing beats that benchmark, why take risks at all? The calculation wasn't about precision. It was about consistency. The same yardstick applied across opportunities. Let them see which ideas stood tallest. Not absolutely, but relatively, the best against the alternatives available. Charlie called this opportunity cost thinking. Every dollar has options. The question is never, is this investment good? The real question is this investment better than my next best option? This mindset cut through noise. Instead of chasing every shiny prospect, Berkshire built discipline. If a business didn't land in the top 2% of opportunities, it was ignored, no matter how tempting. The discipline produced concentration. Munger argued that risk didn't come from holding few stocks. It came from not knowing what you were doing. By sticking only to the best, risk shrank as conviction grew. The focus on owner's earnings avoided illusions. Companies can boast about earnings per share or inflated growth, but if no cash arrives in the pockets of owners, the song is empty, the melody hollow. Charlie once joked that drowning in cash was a fine problem to have. Genuine free cash flow meant flexibility, resilience, and optionality, the ability to act decisively when opportunities appeared. The method required humility. Estimates of growth were conservative because reality is cruel to dreamers. Overconfidence in projections destroys fortunes, while underestimating builds safety. Berkshire preferred to be approximately right than precisely wrong. Consider two businesses, each earning 12%. One distributes cash freely to owners. The other requires reinvestment just to maintain position, leaving no surplus. Same numbers on paper, but one is treasure, the other a treadmill. Charlie despised treadmill businesses. He avoided firms where profits never reached owners, only fed machines, upgrades, and endless capital expenditures. He wanted assets that threw off cash, not ones that swallowed it endlessly. The beauty of Berkshire math was its simplicity. No exotic formulas, no black box models, just cash, time, and opportunity costs. Investors complicated what could be clear, mistaking sophistication for wisdom, missing truth hidden in plain sight. Buffett often said, "We don't know our cost of capital." Instead, he and Charlie measured everything against alternatives. That was their compass. Not theory, but pragmatic ranking, the best option always winning capital. In practice, this meant rejecting most opportunities. Charlie argued that the discipline of waiting was as powerful as the courage of acting. Cash, he said, was financial Valium, calming the nerves while waiting for clarity. Permanent capital gave Berkshire another edge. Unlike typical funds pressured by redemptions, Berkshire could sit indefinitely, holding cash when opportunities were scarce, striking only when the arithmetic screamed obviousness. Time itself became a competitive advantage. Owners' earnings, discounted with the treasury rate, wasn't universally accepted. Many critics scoffed, preferring weighted average cost of capital or other metrics. But Charlie shrugged. He cared about clarity, not conformity, results not theory. What mattered most was consistency. By applying the same framework over decades, Berkshire avoided drifting into fads. The method created a steady filter, screening opportunities across cycles, industries, and market moods with unflinching rigor. Growth remained the wild card. Buffett noted that growth adds value only when incremental returns exceed costs. Otherwise, growth is poison, a tumor that expands but destroys value, devouring resources faster than it enriches. Charlie's disdain for sloppy math had sharp edges. He mocked those who worship non-GAAP earnings, saying the numbers were fantasies crafted to flatter. He wanted truth measured in hard cash, not dreams painted in ink. The detective's task, then, was not glamorous. It was subtraction, filtering, eliminating until the obvious remained. The puzzle wasn't solved by brilliance, but by discipline, patience, and willingness to discard 99 stones to find one gem. Berkshire math showed why compounding worked. A business producing high owners' earnings, reinvested at strong returns, discounted consistently, could snowball for decades. The calculation wasn't magic. It was simply the arithmetic of inevitability. The lesson reached beyond investing. Charlie urged managers to think in terms of intrinsic value when allocating capital. Every decision, expansion, dividend, buyback, acquisition, should be weighed by its effect on intrinsic value. He believed managers who ignored intrinsic value were like pilots flying blind, trusting instruments they didn't understand. Eventually, they'd crash, no matter how smooth the early flight seemed. Thus, Berkshire math wasn't just about investing. It was a philosophy of decision-making. Compare alternatives, discount conservatively, focus on cash, and embrace patience as strength. In simplicity lay resilience, in discipline lay advantage. And so, the chalkboard clears. Intrinsic value remains fuzzy, but the process sharpens judgment, turning the fog of uncertainty into a navigable path. The next mystery is even deeper. What builds the moat protecting value itself? Picture a castle perched on a cliff, waves crashing below, banners fluttering in the wind, and around it a moat filled with dark waters, keeping invaders at bay. That image is capitalism's deepest metaphor. Buffett and Munger often spoke of moats because in a world where competition never sleeps, a company's true defense isn't slogans or quarterly reports, but barriers so strong they bend the laws of survival. You see, without a moat, every business eventually sinks into the swamp of average returns. Rivals copy, margins shrink, and what once looked like treasure turns into sand slipping through open fingers. The castle itself, the business, can look impressive, but the value lies in how wide and how durable the moat is. Because without protection, beauty is fleeting and riches evaporate. Moats come in many shapes. Some are scale-based, where costs fall as volume grows. Others are brand-driven, built on trust and loyalty. Some rely on intellectual property, networks, or switching costs that bind customers tightly. Charlie explained moats in two lenses: the characteristics that create advantage and the resilience that sustains it. A true moat defends itself, growing stronger under attack, rather than crumbling at the first test. Take newspapers. For decades, they had perfect moats, local monopolies printing money. Then technology, like a rising tide, swept them away. A fortress one decade became rubble the next, proof that moats can wither. Charlie asked a haunting question. When you see great results, how long can they last? The detective's job is to uncover why they're happening now, and what could break the spell tomorrow. Durability mattered most. Some moats decay gradually, others collapse overnight. Kodak and Nortel serve as chilling lessons. Their moats eroded faster than investors could blink, destroyed by technology and shifting tides of consumer behavior. Michael Mauboussin described this lifespan as the competitive advantage period, or cap. It's the clock ticking on every fortress wall, reminding investors that even stony roads and defenses falter eventually. Buffett and Munger loved businesses where the moat was not only wide but self-reinforcing, feeding itself through feedback loops, like a river digging deeper channels with every passing season, securing the castle's dominance. See's Candies showed this in miniature. Its brand moat let it raise prices without losing customers, proof that true pricing power exists only where loyalty, habit, and perception form an invisible barrier. Charlie joked that if you need a prayer meeting before raising prices, you don't have a moat. Moats grant confidence, allowing businesses to charge more while retaining love, not losing it. Capitalism, though, is brutal. Producer surplus, the extra profits enjoyed by businesses, tends to leak into consumer surplus over time. Moats resist this erosion, but history shows no moat is permanent forever. That's why fanatics matter. Charlie admired leaders like Jim Sinegal at Costco or Mrs. B at Nebraska Furniture Mart. Their obsession with customers, culture, and execution fortified moats beyond ordinary management's reach. Moats aren't static. They must be widened continually. Like soldiers repairing walls under siege, companies must adapt, reinvest, and strengthen defenses. Resting on past strength is fatal in markets where predators evolve endlessly. Scale often forms the first moat. Chain stores, for example, turn retail into laboratories, each outlet testing ideas, the best spreading, the worst discarded. Scale brought purchasing power, efficiency, and specialization, advantages loan shops couldn't match. Charlie marveled at this geometry. A bigger tank holds disproportionately more liquid per unit of steel. Likewise, a larger operation spreads fixed costs thinner, extracting power from size itself. A simple law of physics turned financial. Advertising scale works similarly. National campaigns are cheaper per customer than local ones. Brands with reach cement their moats through ubiquity, their names echoing in households before challengers even reach the starting line. Supply-side economies of scale often combine with scope. A vast retailer like Walmart didn't just buy in bulk. It built logistics networks, warehouses, and systems that became moats themselves, hard for smaller rivals to copy. But moats also emerge on the demand side. Network effects, where value grows as users increase, create feedback loops. Think of a marketplace where more buyers attract more sellers, which then attract more buyers. Switching costs form another layer. A customer entangled in systems, habits, or contracts stays not because alternatives don't exist, but because leaving feels costly, risky, or inconvenient. The moat lies in inertia and dependency. Intellectual property, too, can shield profits. Patents, trade secrets, or legal rights act as walls enforced by law. Buffett once admitted buying Lubrizol because its patents and customer ties formed the moat he could respect. Moats, though, rarely exist in isolation. Berkshire itself became a living example, its advantages compounding through tax efficiency, brand reputation, trust with sellers, and culture, each factor weaving into a moat greater than parts. Charlie stressed that reputation itself is a moat. Sellers approach Berkshire not for the highest price but for stewardship, culture, and permanence. That goodwill, built over decades, turned into a competitive edge in acquisitions. Yet every moat carries the shadow of decay. Creative destruction, as Schumpeter described, ensures that even giants face erosion. Investors must remain alert, studying whether the moat is widening or narrowing with each passing year. The detective must ask, what fanatic builds this moat? What culture sustains it? What feedback loops reinforce it? And how vulnerable is it to disruption from innovation, imitation, or shifts in demand? Charlie himself saw moats as Darwinian struggles. Capitalism doesn't pull punches. Most businesses die or weaken under relentless pressure, leaving only a few with moats strong enough to compound wealth across generations. For him, investing meant focusing on those rare survivors. He didn't try to predict every battle, only to find castles with walls so high and moats so wide that odds favored endurance. Still, even the widest moat can drown complacent rulers. Great management matters not to create moats from scratch, but to maintain and widen them, pushing advantages forward while others grow stale and crumble. The trick lies in humility. A moat today may vanish tomorrow. The wise investor asks, not just what protects this business now, but what forces might dismantle it gradually or suddenly in years ahead. Because the end game is always the same. Without a moat, returns drift toward the average. With one, compounding becomes exponential, wealth multiplies, and a fortress stands, at least long enough to matter. And so, we leave the castle gates behind, hearing the echo of water lapping against stone. The next mystery beckons, not just how moats work, but how to measure performance in a world of cycles. Walk through the noise of the casino, tables stacked with chips, dice bouncing, dealers laughing. Skill and recklessness mix on the floor, but one rule never bends: the house always gets paid. Markets echo the same law. Subtract fees, expenses, and hidden drags, and the ordinary investor falls short of the market's return. No mystery here, just arithmetic, sharp edge, and absolute. John Bogle built Vanguard on this truth, preaching that indexing was the rational choice for most. Buy the market cheaply, accept its average, and by avoiding costs, you end up ahead of the majority. Charlie Munger didn't disagree with the math. He simply argued that a small minority with discipline, skill, and the right temperament could outperform, but only if they understood the brutal odds stacked against them. Factor investing emerged as another attempt at tilting those odds. Instead of blindly following an index, factor investors screen for attributes: value, momentum, size, quality, volatility, hoping systematic tilts generate superior returns. On paper, it sounds appealing. Why not bias the dice in your favor by favoring cheap stocks or small ones or companies with consistent profits? Factors feel like scientific hacks that outsmart randomness, but Charlie looked deeper. He warned that factor investing often misses the forest for the trees. It quantifies patterns, but strips away context, judgment, and the detective work that defines true Graham-style investing. A value factor might catch cheap stocks, but cheap can mean broken. A momentum factor can capture trends, but trends snap like twigs. Quant screens find signals, but without wisdom, they chase ghosts. Charlie believed human judgment, properly trained, still mattered more than algorithms. The Graham system wasn't about loading a statistical factor. It was about seeing businesses as living organisms, full of quirks, risks, and surprises. Consider Graham's margin of safety. It isn't a mathematical tweak. It's a philosophy, a mindset of humility before uncertainty. Factors measure, but they rarely embody the spirit that protects against ruin. This is why Munger distrusted mechanical solutions. He didn't deny their occasional utility, but he feared they seduced investors into thinking they were smarter than markets, when really they were just filtering noise differently. In his view, investing success hinged less on clever models and more on emotional control. The person who stayed calm, rational, and patient had an edge no statistical backtest could replicate or replace. The market's folly created opportunity, not factors. When crowds panicked, Graham investors found bargains. When greed surged, they stepped aside. The edge lay in temperament and discipline, not in slicing data into buckets. Charlie often said that knowing what you don't know mattered more than brilliance. Factor investing sometimes forgot this, pretending complexity solved uncertainty, when in fact, it sometimes multiplied blind spots and false confidence. Think about poker. Everyone at the table uses probability, but only a few combine it with intuition, psychology, and patience. Factors are the probabilities, but Graham-style investing adds the human art of play. Another difference lay in time horizon. Factor investing tends to look for statistical edges over large datasets. Graham-style value investing focuses on businesses, specific cases where judgment about durability, moat, and management matters. Charlie and Warren trusted their system because it demanded deep thinking. They didn't need hundreds of trades to validate an edge. A few big decisions, made well, outweighed countless small mechanical tilts. This is why Buffett often said that diversification is protection against ignorance. Factor investing diversifies systematically, but Graham investors concentrate where conviction is highest, turning knowledge into outsized impact rather than spreading it thin. The irony is that both systems work. Indexing guarantees average results. Factors can tilt slightly above average, and Graham investing in the right hands can outperform significantly. But the cost is vastly different. Indexing costs pennies, factor funds cost more, and Graham investing costs sweat, time, and nerves. Most people lack the temperament, so indexing becomes the rational fallback, while factor investing becomes an expensive middle ground. Charlie encouraged honesty here. If you won't or can't dedicate the work, accept indexing. If you want to gamble with factors, fine, but don't kid yourself that it's the same as true value investing. Because at its heart, Graham's system is not plug and play. It demands independence, contrarian courage, and the ability to endure ridicule. Factor investing offers the comfort of numbers, but not the armor of philosophy. Wall Street loves factors because they scale. Products can be packaged, sold, back-tested, and marketed. Graham investing doesn't scale easily. It's idiosyncratic, personal, almost artisanal. That difference explains why one fills brochures and the other endures. Charlie liked to call himself a learning machine. He sought wisdom across disciplines, not formulas in isolation. Factors rarely cross boundaries. They stay inside finance. Graham investing borrows from psychology, biology, history, a tapestry, not a table. And so the detective story ends here. We've wandered through moats, margins, misjudgments, and models. The mystery was never about beating the market every quarter. It was about surviving, compounding, and staying sane while others lost their way. Charlie left us with a paradox. The Graham system is simple but not easy. Factor investing is easy but not simple. The choice, in the end, reveals not markets, but the investor's own character. Which path do you take? The automated road of factors, the effortless average of indexing, or the harder climb of Graham's way? The castle waits, but only those who know themselves will ever cross the moat. If you've come this far and still crave more, reach for the original The Complete Investor. There, you'll meet Charlie Munger's words and thoughts directly, untouched, unfiltered. Holding the book in your hands, flipping through each page, you'll find those ideas carry a sharper life of their own, clearer, deeper, and impossible to ignore without pausing to reflect. Give yourself that full experience by owning the original book.